Okay. Well, good evening, everyone, and welcome to the webinar Strategic Tax for Planning for U.S. Business Growth. First and foremost, I want to express my sincere gratitude to all of you for being here today. Your presence demonstrates your commitment to your professional and business growth, and we really appreciate that. We also extend our special thanks to our distinguished speaker, Josh Whitworth, whose experience and expertise will, without doubt, guide us during this session. Additionally, I would like to introduce Leo. Leo will work as our moderator. He's a CFO of a member of a network of hospital, and he's also part of the board of directors. So he will be facilitating this meeting. For those who are not familiar with Hispanic Workforce, allow me to give you a brief introduction of what we are. Hispanic Workforce is a non-profit organization founded in 2019, which a firm belief that addressing the needs and conquering the growth opportunity facing by the Hispanic community in the United States. While our primary focus is supporting the Hispanic community, we are not limited only to this community. We recognize the value contribution that every individual can make to the economic success of this great country and for the whole world also. It's important to note that the Hispanic represent over 18% of the total population in the United States, with significant presence in 3 states where we are the majority in Texas, California, and New Mexico, with substantial contribution to GDP. However, we also face significant challenges such as lower levels of education, also lower wage, and higher poverty rates. This is why we are here today to provide you support and training in the key areas such as professionalism, business skills, and entrepreneurship. So we hope this webinar will be enriching experience to all of you, and then you can make the most of our time together. So without further, I want to hand over the list to Leo to guide us through this session. Thank you again for being here with us today. Thank you. Leo?
Thank you, Enrique. Thank you all for being here today. Some of the additional benefits and the mission of Hispanic Workforce, as Enrique mentioned, is to help the Hispanic community. And please connect to our links on social media and our website. And this is the idea of the organization is to be a resource for Hispanic professionals, primarily business owners, entrepreneurs, and we will be doing these seminars. And if you have any ideas of topics, please let us know in terms of that could be helpful, it could be of interest for your businesses or your professional development. That's the idea of the group, and please help us promote these events as you find it helpful for yourself or for more people. This is a big community, and this is a big effort that Enrique started several years ago, and has very interesting affiliations. One of them is with Microsoft, who was achieved last year, and so the organization keeps growing and helping other people. Another one for business owners that might be of help is looking for talent, to recruit for your companies. This could be a source for that as well. And different needs. It's a good network, and so the idea is to help each other here. Well, after the introduction, I'm gonna present Mr. Josh Whitworth. Josh, thank you for being with us. Josh is the specialist in international tax and obviously domestic U.S. taxes, and he has over 14 years of experience in the accounting industry with a diverse background in international tax compliance and consulting. He also provides federal and state tax consulting and compliance to high net worth individuals and small and mid-sized businesses. Josh's experience includes financial services, healthcare, manufacturing, distribution, oil and gas, professional services, and real estate. He is a recognized leader and often teaches continuing education to other CPAs throughout Texas. Josh is a partner with the firm, the Bonadio Group, which is a national firm with presence in across the United States, and so they serve clients in a wide variety of industries, as you can see, and he knows well. Um, he services several international clients. Uh, we've worked on different things over the years now, and I can assure you that Josh is one of the fewest specialists that know um, how to deal with things across the border. For people here in the U.S. that might have interest in Mexico, he's very familiar with this in Mexico, Latin America, and other countries around the world. And so it's a privilege to have Josh with us. Thank you for your presentation. And Josh, please go ahead.
Thank you, Leo, for that introduction, and good evening. I'm happy to be here, everybody, and thank you. Like I said, when Leo asked me to do this about a month ago, I wasn't familiar with the organization, but talking to Enrique, I think that this is a fantastic, platform, and this is a fantastic organization. So I'm happy to be part of. Hopefully, that we can help just be a small part of growing, with the organization, giving knowledge and information as everybody's businesses grow, and whether it's your business or you just want your professional development to grow or knowledge or whatnot. Obviously my expertise is in tax, and let me see, do I need to share this, Enrique?
Yeah, could you share it over there?
Sorry, let me just share this. Little technical difficulties here. Go.
Okay.
Yeah. Can you see it?
Yes, yes.
Okay. Well, thank you. A few housekeeping items just before I, start. Obviously, everyone that's on this call probably has different has different array of knowledge in the U.S. tax space. So I'm trying to keep it very high level. Obviously, everybody's all in different industries as well. So a lot of strategies and optimization of things going to be more industry based. So I'm not really getting into specifics, but I'll try to, leave, 15, 20 minutes or whatever, at the end for questions for any specific fact patterns. Um, Also, most of this is federal, but remember, depending on what state or if your business is dealing with other states, there could be state implications. Unfortunately, a lot of us in Texas, we don't necessarily have a state income tax, but there's a franchise tax. There's still some filings, but we don't necessarily get into that. But that's just kind of to note. And again, I'll try to add some flavor, to each of these points. A lot of times I just put, words and concepts, and as we go through it, I'll try to. I don't want to overload everybody with too much information. So we'll go through this, and like I said, try to leave any questions, I guess, for the end, because obviously it's depending on what knowledge you have, and we could definitely talk about any one of these topics individually, probably for an hour, because they each have different branches and stuff. So just starting off, I'd like to talk about the different, I guess, the main U.S. business structures that you'll see. And this is from domestic. So, but obviously, if you're a non-U.S. person, you can also set up these structures, and each structure probably is going to have its own own reasoning, for your own why, for why you want to set it up. So we'll talk real quick. We'll talk through sole proprietorships, partnerships, C corporations, S corporations, and limited liability companies. Those are usually the main things whenever you go to an attorney to, initially set up what entity you want to be, and then if you go to a CPA, so we're going to ask questions and say, what really, what makes sense to you based on your business, what do you actually want to achieve, all those, all that type of stuff. So sole proprietorships, those are probably the simplest form. If you do nothing and you go out and you just, don't hire an attorney, do nothing, but you earn business tomorrow, as a consultant or whatever, you're probably going to be a sole proprietorship. There's no there's no filings that you have to do to set up. It's unincorporated. You have unlimited liability. So from a legal perspective, people can go off after your personal assets as well as your business asset. That's one of the biggest negatives. Your activity is going to flow to your individual income tax. So your individual U.S. Income tax. So pretty much, there's not a separate tax return, separate form. It's going to go to what we call Schedule C on your individual income tax return. And as it relates to that, because you're not an employee, you're actually, you're an employer and an employee, so to speak. You also have self-employment tax. So not only would you have income tax, you have your self-employment tax, which could be a pro and a con depending on how you look at it. The pro is, you want to pay into the U.S. Social Security system a lot of times, so you can get Social Security as you age. But the negative side of it is that you would actually, it's an additional tax. And there's a slide later that has the different income tax rates because it's a marginal system. So the highest rate that anyone can pay is 37% income tax, plus your self-employment tax would be 15.3%. The reason it's 15.3 is because as employees, there's a 6.2% the Social Security plus I think there's a I think it's, I'm not sure, 1.45. So the employer, usually if you're an employee, the employer pays half, then the employee pays half. But as a self-employed person, you have to pay both aspects of the Social Security. Obviously, like I said, simplicity, anyone could just go out and be a go out there and do work on a roof or whatever, earn money and go and already have an entity set up, because as a sole proprietor, you don't need to have any extra legal setup or anything. There's this potential QBI deduction, and QBI means qualified business income deduction. So the Congress back in the Trump administration about 6 years ago added a 20% deduction. And the reason this was added is because in that same tax law, the C corps ended up getting an income tax rate of 21%, a flat rate of 21%. And in order to make it where sole proprietors and partnerships who are having to pay at a 37% rate, they gave everybody a 20% deduction to try to make it a little more parity, to make it a little more comparable to each other. As you'll see before, obviously 20% of 37 is still higher than 21%, but C corps also have some negatives with, double taxation, et cetera. So it all depends. Again, it's all depending on what you're trying to achieve, what your objective is, what makes sense for your business. Like, do you have non-US people and US people? Do you have, what type of industry are you in? How much income's actually you're making? What's your 5-year goal? All those different things are going to come into play. And then the due date is April 15th. Again, sole proprietorships do not have its own separate tax return, but that's the due date of what a 1040, which is a U.S. individual tax return. And you can extend that. I don't have that on this slide, but you can extend that to October the 15th if you want. And again, that's for your entire individual. So if you have a sole proprietorship and you have a lot of other activity and you can't get that information, or you're just slow to gathering information, then you have until October 15th to do your final filing. The next one is partnerships. And this is really, all inclusive. This is just, what you're filing is for partnerships. Or partnerships, you can be a general partnership, and it's still a 1060. All the filings are the same from a legal perspective. You could either, you could have a general partnership, a limited partnership, a limited liability partnership. Most people that we see are going to be more of limited partnerships. And that's because, obviously you want to have that asset protection, and you want your investment limited to the money that you actually put into the partnership. But from a tax standpoint, it's not going to really matter the type of partnership. Again, a partnership does not necessarily file any income tax. And the definition of a partnership is pretty intuitive. It's pretty much the same, kind of the same as a sole proprietorship from a filing standpoint, except you have more than one person. So you can have, two individuals. You can have, raising a point, you can have thousands. I think we have one return in our office where we have 13,000 partners. So, I mean, it can go, it can get pretty crazy. Yeah, the software for that one takes about 50 minutes to calculate. So, and the good thing about a partnership is there's no second level of taxes. There are in a C corp that we'll actually see later. The form is a 1065. You still get that same QBI deduction. And also in the QBI, the qualified business, that 20%, if you're in a specified service, you may not get it, like if your income's over a certain level. So for instance, like an attorney, an accountant, I think if you're making over around, I think the number goes up a little bit with inflation, but more than $420,000 or so, then you're a specified business, you may not get it. Whereas an operating company, they can get it if it's more, but it could be limited, but because there's some fancy calculations, just like anything else, that's based on the wages that you pay and on whatever your unadjusted assets in the company that may be. But again, that's if you're not going to really have to worry about that unless your income is unless you're very, very successful in the business. That would probably not become, a huge issue. But as long as you're paying employees, which most successful businesses will have employees, then you should also still probably get the maximum 20% deduction. Partnerships are definitely much more flexible than like in the corporate state. And the reason that is you can actually do special allocations. So, and by that, I mean, let's say you're in it's all based on economics, a partnership is. So no one's going to, get stuck with income. They're not actually, ever getting the economic benefit of distributions or anything. But it's big, like in the real estate industry, where you might have someone, that's really doing the work, but they're getting some sort of a promote or carried interest, meaning that there's a huge return on investment or whatever that exceeds a certain threshold. The promote guy, the guy that didn't put any money in, he might get allocated a big amount of income, but he's also probably going to get that cash as well. Well, in the C corp and in the corporate context, you don't necessarily get that. Everyone is pretty much has to be pro rata. Everybody's, sharing the same. But partnerships, you can craft your partnership agreement and kind of finagle whatever it is. But everything makes sense because at the end of the day, it's all based on economics, and usually, the income eventually will follow the cash. The due date for partnerships are on March 15th. So that's about 2 weeks away. So that's why I'm still at the office, and I'll be out the office this late probably, from now for the next couple of months anyhow. And like I said, with partnerships, depending on the partnership they take, a general partnership, would be similar like a sole proprietorship. You have one individual, you go out and you start business tomorrow. That's your general partnership. It doesn't really take much leg work or effort from anybody. But if you want to set up a limited partnership or some sort of a limited liability partnership, depending on the industry you're in, at that point you'd want to get legal involved, and they would want to craft, because usually a limited partnership has one general partner, and then it has limited partners in there. The general partner is the one that's really so-called managing the everyday activity, and then limited partners are the ones, they're only limited to whatever investment that they're actually putting up into the deal. Now getting into an S corp. So you'll see there's two different types of corps, an S corporation and a C corporation. S corporations, similar to partnerships, do not have to pay tax. They're better than a C corporation, the fact that it's passed through, meaning that you would get a K1, meaning you file your tax return form, an 1120S, whatever your distributable share of the income is going to flow to you, and you're going to report down our personal return. I never really mentioned that in a partnership. That's how that works as well. Partnership's going to file its 1065, and 1120S will file its the S corporation will file its 1120S. It'll do its accounting, pay its income, then provide a K1 to the investors, and they will report that that income on their individual return, and then pay their tax at their individual level. That includes all the other income that they actually may have. An S corporation, unlike a partnership or a sole proprietor, there isn't going to be any self-employment tax. And when it comes to partnerships, it depends. You may have self-employment tax with a partnership, but you may not. Like a general partnership, you probably will. Depends on if you're really operating, if you're active, if you're getting paid a salary. Like I think instead of wages, they call them guaranteed payments, which means you also pay payroll tax on that. But with an S corporation, any distributable net income that's flowing through on the various K1s would not be subject to self-employment tax. But because of that, the IRS is smart, because they don't want someone setting up an S corporation just for the intent of avoiding the payroll tax. So again, self-employment tax is really payroll tax for you to pay into the U.S. Social Security system. So they want you to make a reasonable compensation. So if you set up an S corp because you're making millions of dollars, you have $1 million net income, you take it all out as distributions, the IRS actually may come in and say, hey, no, you didn't pay a reasonable compensation. So they would make you, and reasonable is not defined in the Internal Revenue Code. It's all going to be based on legal analysis and case studies. So that's one question anyone could ask, like, what is reasonable? And that's kind of usually what we do in reasonable to limit the risk is, if someone was making a lot of money and we wanted to do a fine line, would make them at least pay a salary up to whatever the max FICA or Social Security limit is, which in 2023 it was at around $162,000. So that limits the exposure, because that's only out of that 15.3%. I think that amounts like 12.2% or somewhere around there. So your exposure is only the Medicare portion, which is around 3% or so. With an S corp, reason we usually do not recommend S corps. I mean, there's a lot of limitations unless you own 100% of it. Like a lot of people in the medical practice, they'll have an S corp because they're just one person, and that's their healthcare practice. Because with the strict ownership requirements, like for instance, you can only have domestic individuals. So definitely, if you have any non-U.S. people, that's off the board. S corporations also, you can also only have one class of stock. And pretty much what that means, that's a question. When I was a younger accountant, I was like, well, what does that even mean? Pretty much at the end of the day, it means what I was saying about partnership, that's flexible, where I can do special allocations and I can try to make economics work for my business. This means that, everybody must be pro rata. That's one reason, that's probably the biggest reason we don't like it, because there is no flexibility. So if I have more than one person, each one of us have to, pretty much contribute, take the same amount, have the same amount of income allocated to us. There's not really that flexibility in doing that. And the due date for that one is going to be March 15th as well. Pretty much all flow throughs or pass throughs are going to be on March 15th. I think if I covered that. Now I'm going to C corporations. So C corporations, prior to the tax law that passed in 2017, was about 35%. It's pretty higher. So you had 35% plus if any shareholder came out, you would have a second level of taxation on a dividend. So that could be about 20%. So, you're potentially looking at 55%. But once the C corporations passed the law, because as I said, we just went through S corps, sole proprietorships, partnerships, and they could be at 37%. Now that again, it's the highest tax rate, so it could depend. It's marginal, It starts at 10%, and it goes up to like 12. I don't have all the rates memorized, but it starts at 10, and then it marginally goes up until I think you get to about $600,000 taxable income, and it's at 37%. So 37% may not actually even be applicable. So again, when you're talking about strategies and setting up the entities, it's kind of a game, kind of to see, okay, what do I want? Then with a C corporation, like what if you're not actually, I'm taking any money out, maybe you're reinvesting all the proceeds. So, I mean, there's different things to actually, think about. A lot of times it's industry specific. Like I don't think we would not advise anyone to put a real estate into like a C corp. Main reason why is eventually you'll want to sell it and get that out, and it's it's going to be very tax inefficient to actually do that, or any asset. So any high appreciable asset, you probably wouldn't want to stick in a C corp. A C corp files its own return and it does not flow through. So unlike all the other three returns that I mentioned that are transparent and actually go through to the owner, a C corp actually files its own return. So one area where C corps are pretty popular is in the non-US realm, because we will have a lot of individuals that want to stay off the US radar and not file any tax return. The way you would do that, if that was their number one goal in life, you would actually just file you'd probably have them be a corporation. And then if you happen to be in Mexico or any other country, you would not have to file. Even if there was a dividend, the C corporation would take care of all that withholding your tax, and you wouldn't necessarily have to raise your hand for the IRS. Anyway, that's sometimes a tool, and sometimes that is what people's ultimate objective is. Like I said, separation between ownership and management. You have your separate entity, and then if you pay yourself, you might pay yourself in a salary. So you give yourself a W-2. So you keep everything completely separate from the business and you personally. There aren't any restrictions on who can hold shares, unlike in the S corporation where you have several different limitations. You get the limited liability protection like you would in some of those other, and besides general partnerships, sole proprietorships, you're going to get some limited liability. There is again the biggest benefit detriment is double layer of tax, and that's 20%. But again, if your income level is below a certain amount, it could be 15%. And if your income's even lower, like below like 70 grand, I think in certain cases could be 0%. And a domestic C corporation is going to be a qualified dividend. So this assumes that you get a qualified dividend, which would be a capital gain rate. So that's why it qualifies for these lower rates. But still, this is like I said, you have 21% here, which is a flat rate, no matter how much the income the corporation makes. Plus, you're going to have a 20% tax, and this is going to happen if you're if you have an owner that's that's domestic or foreign. A domestic owner is going to receive a 1099-DIV from the C corporation, and then if there happens to be a non-US person, now there could be a tax treaty, et cetera, reducing these numbers. But if there's a foreign person, the default would be for the corporation would owe 20%. But I think Mexico, for instance, I think the treaty says 5%. But there's different clauses in that aspect. And the due date for this is April 15th. And all the April 15th due dates I mentioned, you can extend to October 15th. And then all the March 15th dates for like the other flow throughs that I mentioned, you can extend to September the 15th. And then finally, I'm a limited liability company. They're the most flexible. This one's the most flexible because this one can incorporate from the U.S. tax implications, I can be any of the other four, potentially, so if I'm one owner, the limited liability company will default to a sole proprietorship, and when I say that, I mean, except you have an LLC, so you're a sole proprietor on your Schedule C, but you have limited liability protection, from a legal standpoint. If I have more than one owner, I'm going to default to a partnership. So I'm going to default to those if I do nothing. But you can also make an election and file a form to either be an S corporation, assuming that you meet all the other restrictions and qualifications that I actually mentioned, or you can also, default to be, or not default, you can also elect, by filing I believe it's a form 8832 to check the box, actually be a C corporation. A lot of times, we usually go through the default rule, but again, if I have a lot of times in the foreign or the non-US structures, if I do have a limited liability company, we sometimes will actually, check the box, because a lot of owners sometimes will rather be protected and have it just be a US entity and not worry about the filings on their end. And then real quick, I'm sure you guys cannot see this particular schedule. I tried to do a snippet and get it on there. Didn't work out for me like expected, but I'll just mention it and you'll just have to believe me, I guess. But yeah, if you're, I mean, the top rate, I guess I was a little bit off. I guess the inflation went up quite a bit, but yeah, if you're, it's 37% if you are at, if you're married filing jointly and at 730,000. So to get that top rate, you have to be a really high earner, where you have 10%, 12%. Probably the meat of it is, in the 94,300 to 201,000 spot, you're in the 22% bracket. And again, it's marginal. It doesn't say, okay, because you're in there, it's automatically 22. The math is you do the other rates, and then it's only the difference as you go up. So that's kind of, how it works. And that's important because when you're trying to decide, hey, what's this going to do, from a C corporation or a flow through, like those rates I mentioned, that double taxation, does it really matter? So a lot of times you have to just you have to model this stuff out, and say, does it make sense? And usually when I sit down with the clients, like, okay, what are we trying to do? Like, what are the overall objectives? What does your thing look like? And a lot of times it's more than just now. Because what happens is once you set up an entity, it's gonna be hard to go back. There's usually some negative thing, especially like if you're a C corp. If you're a C corporation, you have to liquidate, and that's a taxable event in itself. So you definitely want to make sure that you try to. And sometimes it does. Sometimes you grow exponentially, and you weren't surprised for good. So you just have to you have to call an audible, if you will, and change entities. But that is one thing to mention. Once you select some of these formations, it's a little more challenging to get out of it and start over. And I have one slide on tax opt. This is really industry by industry specific. So I'm not going to spend time. These are just some high level things that sometimes, are outside the box things that really, that happen or come up. One of the most common things whenever we're doing planning that, someone can usually do is on the retirement end. So a lot of sole proprietorships or partnerships. The simplest thing is like a SEP, which is a self-employed pension. And I believe the maximum this year is 66 grand. And that's pretty much 25% of whatever your net self-employed compensation. That's a good way to get a tax deduction on the front end. And what that does is instead of giving it to the IRS, you're giving it to yourself. Now there's rules where you can take it out, so you can't just do this and take it out next year. I think that there's going to be potential penalties or whatever, but as long as you, put it away and then you let everything grows tax free in your retirement account, it's a lot better. So eventually you can take it out and you can get a tax deduction on the front end instead of giving it to the IRS. Then some people also, if you're really successful, there's also defined benefit plans, which can actually be a lot higher than that 66,000. That's based on actuary things such as age and, and compensation that you're making and all that stuff. And then, there could be a max over the life that you can put in. So that's a little more complicated, but to actually come up with that calculation, but you can usually stock a lot more into that particular plan as well. Depreciation, again, the name of the game for tax optimization a lot of times is defer income, accelerate deductions. I mean, that's pretty much the overall overarching rule. So if there's a way to obviously do stuff where you're not having to pick up the income in one year and you can defer it to the next, it's that generally that's that rule, unless there's a tax law that's going to change it to jack up the income the next year. Maybe you do want to accelerate it, but accelerate, but you want to accelerate deductions generally, and bonus depreciation or 179 expense or way. So you can buy, at the end of the year, a lot of times, clients will call, hey, should I buy this truck, or should I, buy this particular asset? And obviously what I tell them is you shouldn't just buy to buy. It needs to go into your overall strategy of the business. I mean, that's kind of a common sense term, but sometimes people will say, I'm like, there's got to be a reason for to achieve your other business objectives. But bonus depreciation, one thing that happened with bonus, it was 100% until 2023. I think it dropped to 80%. However, there is a law circulating around in Congress that would put that back up to 80%. So we'll see what happens. But 179 is still out there. And 179 means it's also another way just to expense it. That's not as flexible as bonus depreciation, because bonus, you could just take 100% bonus, be done with it. 179 has some other limitations, such as, do you have taxable income? There can be, some stuff where you may have to carry it over. So bonus is definitely much more favorable. But 179 is still around there, and you could potentially use that. And if you are in like the real estate industry, or you are buying a lot of properties or warehouses or anything like that, cost segregations are something to utilize, and that usually requires a study. The whole idea of that is to real estate generally, 39 years, if it's commercial, or 27 and a half, but cost segs can break out some of the personal property, some of the other items that would be 5-year and 7-year, because real estate does not qualify for bonus or 179. So you can never buy a property and get $5 million write-offs, but you can do like cost segs and have them, oh, there's this fancy refrigerator that's, worth half the building or whatever, because it's like a super machine, they can allocate and segregate that out, and that could give you, some immediate benefits. But again, that's industry specific. If you have a lot of research and development, that's again industry. If you don't have that, then that's an issue. But you get credits, and a credit's a dollar for dollar on your tax. Like deduction, that's just going to reduce your tax. Like if you're a C corp, you're going to get it's going to be a 21% tax savings, for the most part. And an R&D study, you'd get, be 1-to-1, as a general rule. Work opportunity credits, those are also studies that can be done. That's like if your business is hiring people from certain targeted socioeconomic groups, that, may just stereotypically be discriminated against or whatever, you can certainly, hire those, and that incentivizes businesses to hire those particular individuals. So those are credit out for that. And then record keeping and substantiation, it's just important to know, like whenever you give it to accountants or whatever to make, it's up to you, obviously, like me as a CPA, if you email me something, and I I don't necessarily need all the backup, but you as the taxpayer would definitely need to be able to substantiate, the mileage that you have in your car, the cars you bought, obviously, again, a common sense thing, but, the more aggressive you are, the more, the more you definitely need to have your ducks in a row to be able to support that whenever the IRS comes knocking. Just a few things. I wanted to just touch on a few deals. I'm not going into detail. This is, again, since my specialty and my background and my cream of the crop has been in the international tax space a lot. I wanted to throw out some terminology, I guess, just some words to be, and then I'll just kind of explain some of these words to be careful with, and like when you're dealing with a cross-border environment. So if you're someone from Latin America and you're coming to the US, and you're doing, business, like there's ECI. ECI is effectively connected income. So if you have effectively connected income with the US, the US is going to require them to file. Again, we talked about all domestic stuff. If I'm an individual and I have a foreign individual can create an LLC as a limited liability company as well, and they can own it 100%. Well, if they do work through that as a single owner, they're going to have effectively connected income. So they would need to report that on their 1040 NR and be subject to, similar graduated tax rates that a U.S. person would be. Withholding is a big one. So withholding in the partnership context, because a partnership, we mentioned those, they can have domestic, they can have foreign individuals, etc. One person could be like, well, I could just create a partnership, have a foreign person. The IRS doesn't know who I am, so therefore, and I can distribute that to that foreign person and get away with it. Problem is, the IRS is smart enough to know that, so they put the onus on the partnership. So if the partnership fails to withhold, generally, assuming it's ordinary income, would be 37%. If it's capital gain income, it'd be at the 20%. So that, which is the highest rate. So it doesn't even matter that your rate's in a much lower bracket. They're going to make you withhold at the max rate because IRS wants to make sure they get their flesh. So it's going to be up to the partnership, and that's really going to be considered a distribution for that individual because the partnership is paying the tax on their behalf. But the biggest thing that is important in that era to get across is the risk really falls on the partnership, because IRS knows they can't go out and get that non-U.S. individual, but the U.S. entity, they can go after the whoever the manager of that partnership is, and then they distribute out all the cash. They're going to have to somehow come up with it. Inbound, I'm a little bit like going back to ECI. Inbound is if a foreign person is coming to the U.S. to do business. And then outbound is if a U.S. individual is going overseas or offshore to do business. And something that's always going to be, at play in this type of stuff is like transfer pricing. So the U.S. and all whatever other country you're in too, for that matter, they want to make sure they get their income. So if I'm doing, because theoretically, if I have an expense or income, one entity is going to be expensing it, and then another entity is doing, you can have income. So if I'm a U.S. If I'm in the U.S. and I have a management fee for a Mexican entity, and I pay a management fee to that Mexican company, and now I'm taking a deduction, and therefore I'm shifting that income to Mexico. So U.S. doesn't really like that necessarily. So that's why everything has to be arm's length, which is another concept means it needs to be comparable and fair, which it would be to an unrelated party. And then you obviously need to be able to support that. So that's another concept I want to make. Outbound, I just mentioned that's kind of, off. If I'm a U.S. person doing business offshore, and that's where the concept of guilty and PFIX can come into play. And guilty is only going to be in play if I have, a corporation that I own more than 50% of. Again, someone might think I can just set up an entity in the Cayman Islands or Hong Kong or some other tax haven and have it be really successful and do and get all the benefits of the appreciation, so I would never pay tax. But the IRS, again, is smart enough to know that they're going to make you pay tax currently, regardless if you repatriate that or bring that back home. They're gonna make it be considered taxable right then. And then PFIX, again, that's a passive foreign investment company. Those are things saying, hey, they're pretty much trying to make sure that you are investing in the U.S. So like, hey, if you're investing in this stuff, you're not, you're not creating to the economic growth of the U.S. So therefore, we're going to penalize you. There's no business purpose. I think in all these things, if you can prove a business purpose, you're probably okay. But a PFIC is something that's just generating passive income. So they're saying, I'm investing, I'm doing this to get profit. So again, there's extra forms to file, and the penalties are pretty outrageous and draconian in this area. And that's kind of what I'm mentioning by the disclosures. There's any non-US bank accounts need to be reported. Again, there's no tax with it, it's just for transparency, etc. But the penalties are crazy for not reporting, and it's up to like 50% of whatever your max value in the accounts can be. So it's important just to, at least disclose these forms. And these forms are going to be on all those various entities I mentioned. If you're a US owner, a US person could be a individual, a partnership, a corporation, a trust, any type of entity is going to be classified as a U.S. person. And as I mentioned, the penalties are pretty, pretty ridiculous in those. So a lot of it's, you can teach, a 4-hour class in each one of these concepts, and I've done it before. And this is a 2-minute synopsis, but it's just kind of interesting. If you run across anything that you're dealing with entities, whether it's inbound or outbound, just to kind of know, and then at least raise your hand to get help at that point. Just a couple other things, foreign earned income exclusion, it's for like an expat, so someone that's, going over outside the US and they're out for at least 330 days, they can exclude, I believe the number is like $120,000 this year. They can actually exclude that income if they're actually working out, or they can be a bona fide resident of a particular location. Foreign tax, most places, you get a credit in the US for foreign taxes. So you're not usually paying taxes twice. If you're in certain countries, you could be, like if there's not very good diplomatic relations with the U.S., sometimes there's some pretty crazy rules but you rarely see that. And tax treaties, it's important. Tax treaties will a lot of times give you better rates than what their general rules are. And most, like Mexico, for instance, they have a tax treaty and will give you some beneficial. Most other Latin American countries do not have tax treaties. There's 1 or 2 in South America, but most people are just going to default to the general rules, and the general rules are not that friendly. And then foreign gifts. If anyone's getting gifts from relatives or transferring money back into the U.S., there could be extra disclosure. There is an extra disclosure. I think the penalty is like 35% for failing to on that gift. And again, there's no tax implications. It's just someone in Congress needed to balance some bill at one point, so they decided to throw that into some law. But again, just something to keep an eye open. If pretty much any cash is being transferred cross border, it's probably worth vetting it to make sure that you're in good shape. Anyway, there towards the end, I kind of spoke about 100 miles an hour. So I think that's kind of, close to the end. So if anybody has any questions, I'm assuming that you stayed awake for the whole time. I'm here. I'm happy to help either here or offline if you have a more pointed or more challenging question.
Hi,
Thank
Josh.
you.
This is Mauricio Galván. I have a question for you. What options do we have as small business owners to set up, in addition to the SEP that you mentioned, retirement accounts, tax efficient retirement accounts, where we can make contributions and reduce our tax burden, but save at the same time?
Say that one more time on the question piece. I know it's related to retirement accounts. So what was the?
What options do we have as small business owners to set up retirement accounts and
Oh, what
reduce our
option?
taxes?
Okay, so I think the SEP that I mentioned, pretty much that one's the easiest to set up. There's not really any. I mean, it's just call your local financial advisor. I mean, you could probably do it on an E-Trade account, but for an SEP account. So first of all, you haven't, I didn't mention this, I forgot to mention this, but you actually have until October 15th of the following year. So for 2023, I have until October 15th of 2024 to contribute to an SEP. And the reason is because there's probably no way that you can know what your max SEP is until you filed your return. So they give you until the due date of the tax return to actually be able to contribute that, because that's 25% of whatever your net self-employment income is. So really you have to be doing your taxes and going to a professional. And then once you know that number, a lot of times, I'll give that, I'm the one that gives that number and I'll let the client know. And then they'll reach out to whoever their financial advisor is to set up that account or make that contribution. Does that make sense, Mauricio, or did I?
Yeah, nope, thank you. That's perfect. Thanks.
Josh, I have one question on there's we have presidential election this year, and there are some taxes that are. Can you speak to some of the main changes happening now and the ones coming? I understand there was some piece of legislation pending. I don't know if it's already been defined for this tax season. And
Yeah,
what are
so-
the main things to expect for this year, looking forward, different
And-
changes that might affect individual tax burdens or corporate?
Yeah, so the biggest one is probably that bonus depreciation I mentioned. There's a lot of other changes. They're so small. Like, for instance, they're updating the Taiwan tax treaty. There's a lot of like silly stuff like that that's not really going to affect us. But probably the biggest one that'll affect small business owners is going to be bonus depreciation. So if the law doesn't pass, it's going to be 80% bonus in 2023, 60% in 2024. 40% in 2025, and it's gonna like eventually, go away. And that's a pretty large hit. Because bonus and it's just a timing difference, theoretically, just depreciation. If you take depreciation, that's gonna reduce your tax basis to zero. So if you don't take depreciation, your basis is still gonna be whatever you bought it for. So technically, if you sell that asset, your gain's not gonna be as big if you actually if bonus goes away. So it's important to mention saying that, hey, your tax, this is going to substantially increase taxes. It just means that your hit may be a little bit more because you're not getting that. Like I said, the name of the game is to accelerate deductions. So it's limiting or hindering your ability to accelerate such deductions. But that's probably the biggest one. Another one that's probably not going to affect this group is like the interest limitation. But again, you need to be over $25 million of revenue on that. So you're probably going to be a larger business. But I think the biggest one for small businesses is probably the depreciation deductions kind of going away.
Thank you, Josh. One last question. Anybody? Okay.
Yes, thank you. I got a question. So you didn't mention anything about the FBAR. I know there's a requirement for foreign bank accounts. I know there's a limit. You can give us a little bit more
Oh, yes.
information regarding that. Thanks.
Yeah, yes. Well, I am. I didn't actually mention it by FBAR the form, but I guess I can go back. So yeah, so that's probably the biggest one that would affect you guys. Number one, the threshold's not that high. It's that if you have an aggregate of bank balances of more than $10,000, then you have to file the FBAR for every account, regardless if the account's zero. If I have 11 accounts that have $1,000 in it, I would need to file the FBAR, and I need to file it for all 11 of those accounts. And that's the one where the penalty is 50% of whatever your max balance is during the year. So there's been certain cases that, let's say I'm trying to get a mortgage and it's in some account for like half a second. There's like $1 million sitting there, and it's not really even my money, but now that's an FBAR requirement, and technically the IRS can come in there and take half of it, but I might have put it in a house now, so it's not even liquid. So there's a lot of illogical things that happen with that, but that's going to happen no matter what any U.S. person, and a U.S. person is described as an individual, partnership, corporation, all the different entities is going to be really is going to come under the umbrella of a U.S. person. So, it's very hard. And again, there's no taxes implications with that. It's just disclosure. There's no point really trying to get creative and hiding all that type of stuff because, assuming you're not doing anything else crazy, non-tax related, there's going to be no point in trying to do anything not to report stuff because there's no, and I usually are really conservative in that realm. If we're like, I don't know if you have to report it or not, because sometimes with pensions and retirement accounts, there can be some gray area, but usually I'm always erring on the side of caution and I take the gray out of it and we just report it with the penalties being as crazy as they are.
Have you seen those
And
penalties
how
actually?
Sorry, and then how do you consider, how do you evaluate if it's an account that you need to disclose or you need to have a report? I don't know into what level of involvement you need to have into that account.
And when you say involved, so obviously if it's just a bank statement, you usually go through the bank statements. So when you say involvement, do you mind?
Let's say for example, it's my mom's account back in Mexico, and I sign in that account. It's not my account. I only have access to the account. Is that an account that I need to report?
Yeah,
So how do I have to be involved in the account to be eligible for me to report it?
Yeah, it's interesting. You just brought up another element that I accidentally report. So it's either financial interest or signatory authority. So for your example that you mentioned, I guess since you have access to it, so it's called signatory or other authority. So theoretically, since you have the power to sign, you should have the power, I guess, somehow to get those statements. And then from a practical perspective, there has been situations where we have not had the ability to get the statements. Maybe it's a country that, it's impossible to get bank statements out of. Maybe it's because, since you don't have financial interest, it's hard to get that. So and when that's the case, sometimes we report a much higher number than we think there is, or we'll do whatever the best information is available. But the important thing is to try to at least file it. But there are some instances where it's impossible or impractical to get the number, and you just try the best you can. And sometimes you just disclose it, and sometimes you can even put an attachment and say, hey, this to give a little more flavor. Although we normally don't do that because I don't want to necessarily raise my hand to the IRS saying that there is that issue. Does that kind of come up to Carlos? But I think you're saying like if you don't have actual access to see what the number is.
No, yeah, I think you answered my question. Thank you very much.
Right, if there's no other question, we'll wrap it up here. Great presentation, Josh. Thank you very much. Thank you all for participating. We'll keep you informed of other sessions like this, and if there's anything that this might be of help for you, please reach out and let us know. Happy to have you involved and help us grow the organization. Enrique, any comments?
Yeah, thank you. I would like just to share my screen again.
Oh,
just to share the
I gotcha.
Just let me see. This is our webpage, Hispanic Workforce, and a little bit about what you could help us. We'll donate. Also, you could also know about our organization, what we do, the services that we collaborate, also the team that is behind us. We have legal, financial, everybody involved here. Also, about the services. We have, as Leo was mentioning, we have an agreement with Microsoft to develop this program, Microsoft Empower Hispanic, Google Empower Hispanic, Digital Empower for Hispanic, financial advising, legal consulting, job seeker. Also, we have some, for instance, some opportunities to, if you have your business and you are looking for some resource, we could help you to find the resources, and we don't charge anything. We are a non-profit organization. For instance, for the Microsoft Empower Hispanic, we are giving a lot of seminars, a lot of training in all the tools for Microsoft with some expert from Microsoft. If you are interested also to help us being volunteer or working as a speaker here, or you are interested in all the events that we are providing, you could see here by month or by week or by these are kind of the event that we are providing, and here you could also register in the event. Contact us or Spanish, English, whatever. We are local presence in all the social network, in Facebook, Twitter, well, X now, LinkedIn, LinkedIn, YouTube, Instagram. So thank you very much. Let us know if we could help you in anything. We are here to help you. Thank you. Thank you, everybody, for your participation. We hope to see you later.
Thank you all. Have a
Thank
good
Thank
night.
you.
Thank you, Josh.
Thank
Thank
you.
you.
Thank you.
Thanks, Josh.
Bye.
you.
Bye.
Thank
Bye.
you. Bye.
Bye.
Thank you.